All right, today we're digging into a really interesting company in the specialty chemicals world, Azelis Group. And the big question we're asking is pretty simple. Has the market completely overlooked a top-tier business here, maybe creating a real opportunity for investors? Let's jump in and see what's going on.
I mean, think about it. What if a fundamentally strong, growing company was trading at a serious discount? That's the dream scenario every investor is hunting for, right? Well, that's the core idea we're going to unpack today with Azelis. And this slide right here, this is the whole story in a nutshell. On one side, you've got the market, and it's worried. It's worried about a recession, a slowdown, and profits getting squeezed. But on the other side, when you look at Azelis specifically, the thesis is that you've got this super resilient business with a proven way of growing that might be, well, just plain cheap right now.
So let's start with what's happening right now. Like a lot of companies in the space, Azelis has been hit by some economic headwinds, and yeah, its stock has taken a pretty significant tumble. The question for us is, does that price drop mean the business is broken, or is this just a temporary sale on a really high-quality company?
To even begin to answer that, we first have to get our heads around what Azelis actually does. And I'll tell you right now, they are not just some simple logistics company that moves boxes from point A to point B. Their entire business is built on adding a ton of value along the way. In their own words, Azelis calls itself an innovation service provider. Think of them as the ultimate matchmaker. They are the critical bridge connecting thousands of chemical suppliers with tens of thousands of customers, making this incredibly complex web of supply chains feel simple for everyone involved.
And that is absolutely the key thing to remember. The real magic here isn't in the trucks or the warehouses. It's in the brains. It's the technical expertise, the advice on how to formulate a new product, and the deep market insights they give their customers.
And here's their secret weapon. This is what sets them apart. They operate over 70 of these application labs all around the world. This is where they work side by side with their customers, helping them solve problems and develop new products. This creates these incredibly deep, sticky relationships that are just so hard for any competitor to come in and break up. Now, check this out. A whopping 63% of their money comes from life sciences. We're talking about things like food ingredients, pharmaceuticals, personal care products, stuff people need to buy no matter what the economy is doing. This gives the whole business this bedrock of stability, even when things get rocky. Okay, so we've got a stable, high-value business. How does it grow? Well, Azelis has this really powerful strategy they call buy and build. You can think of it like a jet with two engines, both firing at once to propel the company forward. So engine number one is acquisitions. They strategically go out and buy smaller companies to get into new countries or new product lines. At the same time, engine number two is firing. That's the organic growth. They use those labs we just talked about and work to sell more stuff to their existing customers. It's this 1-2 punch that really drives growth.
And listen, this is not just some theory on a PowerPoint slide. They are actually doing it. In 2024 alone, they snapped up 8 different companies. This is a business that is actively and aggressively building its own future, year in and year out.
Okay, so we've established it's a high-quality business with a growth engine that's clearly working. But what's the market willing to pay for it? Now this is where the story gets really, really interesting. If you look at the numbers, Azelis is trading at about 10.6 times its earnings. Now, its closest public competitor, a company called IMCD, trades for over 13 times. And maybe even more telling, when similar businesses are bought and sold privately, they're going for around 13 times too. You see that gap? That's a pretty big disconnect. And what makes that valuation gap so fascinating is that these two businesses are almost identical twins when it comes to quality. Just look at their profitability metrics. Their margins are practically mirror images of each other. So you have two businesses that are performing at the same level, but for some reason the market is putting a much lower price tag on one of them.
Of course, it can't all be good news. No investment is a sure thing. So let's be smart about this and run through the investor's checklist. What are the big things that could go wrong here? What's the bear case?
Okay, risk number one, the big one. What if the global economy really hits the skids? A chunk of their business is tied to industrial markets, and a bad recession would definitely hurt demand there. So what's their defense? Well, first, remember that defensive cushion we talked about? 63% of the business is in stable life sciences. Plus, they're spread out all over the world, so a slowdown in Europe could be balanced out by strength in Asia or the Americas. And on top of that, management isn't just sitting around, they're already cutting costs to prepare. All right, the second major risk is all about that growth strategy. They rely so heavily on buying other companies. What if they just can't find any good ones to buy? Or worse, what if they buy a company and completely mess up the integration?
This is where you have to look at their history. And frankly, their track record is excellent. They've been doing this for a long time, and they're good at it. They also tend to buy smaller, tuck-in companies, which are way less risky than betting the farm on one giant deal. And maybe most importantly, they've already locked in the financing they need to keep that M&A engine running.
So when you put it all together, it really boils down to this final crucial question. Making all these acquisitions costs money, and it can temporarily weigh on your profit margins. Is it possible the market sees that short-term cost and is mistaking it for a long-term problem? Are they seeing a sign of a deteriorating business when it's actually just the price of building an even bigger, better one? That's the question an investor has to answer.